Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase, a podcast where we help you focus on market events that we believe truly matter. Now it was Fed Chair Powell's day in the sun. His renomination hearing at Congress, his focus on inflation risks, and why policies like to be less accommodated from here were largely along expected lines. He said inflation posed a severe threat to the US recovery and said the economy no longer needs or wants the highly accommodative policies. Brainard's hearing for confirmation as vice chair, of course, is next. Now, this focus on inflation, something from Powell's comments and data over the past week or so, is far from a US phenomena alone. Amid the many reports out there, one we thought that stood out in particular was Japan's Tankan survey of manufacturing sentiment. Here, in a market where policymakers have struggled to achieve inflation for a very long time, reports showed that headline optimism was partly offset by signs that margins were under pressure from rising raw material and energy price inflation. Now, after this data and Powell's testimony, of course, what we thought was interesting is how many major markets treaded water overnight. US bond yields were largely unchanged and the dollar was down a little bit. Technology sector equities, of course, were one key exception, rebounding fairly strongly, as were commodity prices, with oil in particular rebounding quite strongly. Now, coming after what's been more than a week of markets adjusting to a higher inflation outlook and what looks to be a less accommodative policy from the Fed in 2022, market reaction does increasingly suggest that Powell's comments and some of the concerns he highlighted are now not surprising the market as much as they did a few days ago. So given that sort of context, I thought it was a good opportunity to have a chat with our CIO office's technical analysts just to understand how to place the recent market reaction in context of both the market reaction and technical indicators. And based on what he published in our last weekly on Friday, three messages really stood out to us. One is that when you look at US 10-year Treasury yields, they're now approaching a significant technical resistance zone. We last flagged 1.77% to 1.97% as a zone of resistance that could slow a further rise in yields. Second, the US technology sector still looks very much like a pullback within the uptrend, not a reversal. And that's supported by the fact that the 200-day moving average is still offering support to that sector index. And third, Euro area financials are still showing rising chances of a bullish break. And if you had a chance to look at a weekly, you'd recall that complements a chart in there that showed that the sector's valuations are quite strongly discounted versus the market. So overall, when you pull these technical messages together with the market reaction, it does seem to be still very much consistent with the buy on dip in our preferred risky asset classes message that we'd highlighted in our publication last Friday. Now, looking ahead briefly to the rest of the week, besides, of course, the US inflation printout due today, we are starting to refocus on the US Q4 earnings season, which kicks off later this week with the financial sector. And separately, in this part of the world, China and India are set to release producer and consumer price inflation data later today. So, if you enjoyed this podcast, please don't forget to rate and like it. Thank you very much for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.